Hi everyone, welcome to session number 2. Today we will touch on the three themes to strategic cost management. As we discussed in the last session, there are really three vectors associated with strategic cost management. The first one is the value chain analysis. The second one is strategic positioning analysis, and the third is the cost driver analysis. What we want to reinforce as we go through the next set of slides is there is a fundamental difference between management cost accounting and strategic cost management, and hopefully some of the case studies in these case studies we will definitely flesh that out. Not just in this lesson, but in the next lesson, especially where we actually go through a very specific case that I need to share. What differentiate cost management cost accounting and the types of conclusions that we do come up with management cost accounting in a traditional sense, and then shifting gears to strategic cost management. On the high level conceptual differences, when we start with the first vector, which is value chain analysis, is what is the difference when we look at a strategic cost management picture versus a management accounting picture? A management accounting picture is fairly simple. Ultimately, what you are looking to do is assess your cost base relative to your sales and support firm's business, which is to maximize the profit and shareholder value. But the value chain analysis is a bit more complicated. It is actually not just looking at what's your cost structure, but also looking at who are the different people who are influencing those costs, and if you as a firm can go out and influence your customers, competitors, investors, and even suppliers. This is a mapping of how value chain concept comes into play. Starting with customers, what type of customer support do you want to render as you launch products? If you're a company like Google, you may rely heavily on a self-service model, and even Microsoft relies really heavily on self-service model compared to, say, Apple stores. When you think about these technology giants, it's quite unusual that Apple was the one that decided to take a very different route in terms of reaching out to its customers. That really goes back to, again, this value chain concept, where they realize that they can actually garner higher margins and more product sales by having a retail presence. Competitor is, again, fairly intuitive. This is going back to the notion of what can you do or cost that you would incur to stem off competition. So there is conventional stuff, but beyond that, some of the negative tactics, if you will, that people have engaged in the past. Example is Japanese electronic firms were dumping products, so they were essentially coming to the US and dump any excess inventory well below the market price, not necessarily to garner profit, but essentially to drive competitors out of business. Again, illegal under the World Trade Organization, but there are definitely companies out there who are continue doing that in certain circumstances. And let's switch to regulators. People don't think about this from cost management standpoint, but what's the same is, there is no escaping from debt and taxes. So, well, it's really true. And if you look at from average P&L of a firm, taxes taking into account a healthy percentage of income before taxes. So it is substantial portion, and really thinking about those costs, well, whether it be tax mitigation strategies or tax avoiding strategies, all the way to how you deal with someone like the EPA type of agency if you are a manufacturing company. These are, again, strategic concepts to consider, especially when you are building out your value chain, where all of a sudden you may decide, hey, it doesn't make a whole lot of sense to build this huge car manufacturing plant in Singapore, where the EPA equivalent organization is super strict on emission standards, and how you actually build the car compared in a different country. Fourth is investors. Again, there is a cost there. If you think about it in a very conventional sense, there is a cost of going to public, but also there is cost for negative investor sentiment. It's extremely high, especially for companies to raise capital. So people don't really think about that, but generally serving and being transparent to your investors goes a long way in terms of helping you out. Same is true for number 5, suppliers. This is again a very traditional concept. These are the folks that you basically get most of your primary inputs from, and that's where most of the conventional cost management accounting analysis is brought to bear. You will typically look at things like, let's consolidate the number of suppliers, for example, for a particular part. So we will get more to that later. Again, this is just a mapping of the value chain analysis. We look at core activities, inbound logistics operations, outbound logistics, marketing and sales, and services, and actually break the cost into each of those primary activities, as well as the secondary activities on top, which is infrastructure, HR management, technology, and procurement. What you're really looking at in each of these boxes essentially is the margin contribution. What you want to do as a firm is to focus on those activities that are, number one, are absolutely essential to your products and give you a competitive advantage in your products, and number two, only focus on those areas where you actually are garnering a high enough margin. For example, it doesn't make sense if you're a company like Apple, where you are really not in the business of trying to run a factory. They outsource that and rely on Foxconn, a manufacturing company based in China, to make all the iPhones and iPads and different product lines for them. One of the best demonstrations in sort of how powerful value chain concept is as a tool compared to conventional cost management is here. A conventional cost management on a US manufacturing plant, if you go back in time, would have told you during the 80s and 90s that one of the biggest challenges that the car manufacturers face are holding costs for excess inventory. So they have all this excess inventory. There is competition during the 80s. We saw the oil crisis, a slowdown, and a general recession in the economy. And what the US companies did is they looked at their competitors in Japan and said, hey, how is it that they are able to actually maintain such a low inventory and continue to beat us in our own backyard? Ultimately, what they decided is we need to go to a just-in-time system, because that's absolutely important. The authors in your textbook go through this in detail, but what ended up happening is actually higher cost because there is a lack of partnership and coordination with the key suppliers. So either you had a supplier who delivered poor inventory from quality standpoint, or the timeliness was off, and ultimately the supplier incurred the additional cost to try to maintain a just-in-time system, because they were second-guessing the GMs and the Fords of the world in terms of what exactly they were doing. So what ended up happening is you destroyed your inbound logistic, the very first box on the previous slide, and that you're essentially resulting in a severe depreciation of not just the brand, but the perceived value of American car, because the suppliers were the ones who actually took the biggest hit, and they had to cut corners to make it. If you ever wonder what was the key takeaway in terms of transformation of the American automobile industry, it's really the notion where American firms really tried to change their value chain to try to match a competitor, as opposed to looking at end-to-end and understanding where the cost would be incurred from such a strategy. So again, that's a very good conceptual example where conventional analysis was a big letdown. Definitely there are a lot more examples, so I'm not going to go through this in detail. If you really think about the time where the world is headed, is, for example, it's becoming increasingly difficult to predict weather patterns with global warming phenomenon. If you're a retailer and you are thinking about trying to have an inventory management based on JIT, all of a sudden your life is a lot more difficult, because you may intentionally want to hold excess inventory or fully burden your floor space with all types of different categories and inventory in terms of warm weather or cool weather, because you are not really sure when the demands might come into play. So again, this is one of those things where once you have done a value chain analysis and you have actually gone back further up to the service portion, where the voice of the customer may be telling you, hey, I know it's summer and it's July or August, but the weather is extremely cold. I would definitely like to have a sweater. And if you are one of those retailers who are the poor product lines in terms of sweaters, then there is something usually called weather, so you may have to recalibrate your just-in-time system to even maintain excess inventory intentionally to service your customers. And these are more contrarian examples to just-in-time. One of the biggest ones is, as the US car manufacturers, for example, illustrates, if you are going to do a JIT system just in time, you have to be tied not just at a very tactical level, but at a strategic level to your suppliers. And that often means, if you're a large company, you are going to go to one of the preferred suppliers in your industry to help you maintain your operations. And oftentimes what happens is that exposes you to supplier concentration. So this example here, what we go through is in Thailand, where there was a lot of flooding and that actually wiped out 30% of the global hard drive manufacturing. It is a terrible thing when a JIT system is put in place extremely effectively and all of a sudden you as a firm are exposed to this considerable amount of risks. So the crux of this entire discussion being whatever the tool is ultimately that people have come up with, whether it be JIT or whether it be the internal vertical integration or the horizontal integration, you will see all those terms thrown around. And all they are talking about is reconfiguring your value chain or looking at your value chain to see where at the greatest margins are and how do you best position your company against the competitors. The disadvantage is people who deployed the basic tools like JIT rarely sit back and look at the value chain and understand when the risks are. So like the clothing retail example or the US car manufacturing example, you may never inevitably be shifting costs when you would apply these tools either upstream or downstream. So it's extremely important to keep in mind a value chain concept as opposed to a single activity when you are doing cost analysis. Related to value chain analysis, there is also this notion of life cycle cost analysis. The example here is essentially the evolution of maintenance costs on different cars. So what this slide goes through is you may purchase, for example, Honda Civic, and the purchase price is one on the left here, maybe quite high compared to let's say a Toyota Corolla. But what happens is, as you look at through the cost over time, the Honda Civic may actually provide to be equal, if not cheaper, than the Toyota Corolla. And think about this not in a small purchase environment such as the one above or in the slides, but think about it if you work for Chevron and you are building drilling equipment for offshore oil, and these projects can go anywhere from 10 to 20 years depending on how much oil they can find. And ultimately it's not just the cash flow that you take in with the initial investment, rather It's really looking at life cycle cost, ensuring that you are appropriately gauging your ROI analysis. And this again goes back to the notion of value chain, where you look at your supplier, your inbound logistics, but also breaking it down even further, seeing where the recurring services to support you as you increase operations, as you go into more long-term ventures. From a life cycle cost analysis perspective, the reason why you have companies that engage in it is fundamental to reduce the maintenance cost or the life cycle cost. So if you're a company and you're engaging in a long-term project, even if the initial investment seems expensive, the idea here is to think about the quality of the product that you are going to buy and the premium that you might achieve against your competitors. Despite a shortfall in cash flow in the beginning, so again, if you are a fabrication plant and you have a choice to build a $15 billion fabrication plant, that's a lot of money to put in upfront, but the upgrade cycles or the types of chips that it can support over the next 5 to 10 years, because the tooling is so advanced compared to working out maybe only 10 billions for a smaller size fabrication plant. And that's a very big difference in terms of how you as a company are thinking about strategy, as well as how you as a company are trying to position your cost and your cost structure to maintain margins long term. And if you have a very short life cycle in an industry, especially like electronics, it may actually make sense to go ahead and fork out more money up front with the $15 billion. So again, it's not just the maintenance cost, and that's why we use the word fairly loosely here, really thinking about the life cycle cost when you are doing a value chain analysis. Strategic positioning analysis is the second vector. We've touched on this before, the same example. So you have a product attributes such as a brand image or the performance of the vehicle, and you have costs, and ultimately in an industry, a company may either position itself as a product differentiator or as a cost leader. And sometimes you find an odd example like Apple, where they're able to do both. And this again elaborates on the concept of product differentiation or cost leadership. Generally, you want to focus on one or the other, and if you do not, there is a lot of risks of being in the middle. So when you think about organizing a firm and all these different activities, like to say a role of engineering, product cost, and assessing performance and product differentiation, there is a lot of focus on cost leadership. So where you deploy your finance resources, especially if you are a controller or CFO, it changes quite a lot when you think about how the company from top-down approach is positioning its products. So the list here gives you an idea from strategy standpoint, if you guys become executives someday, which I hope you all do, how you would want to deploy your finance resources to support your business partner. So it's sort of one of those benign topics that may or may not make sense right now, but when you really think about finding a company, and let's say you have only 20 major accountants or financial analysts to allocate, having a good understanding where the company headed will definitely help you deploy your resources appropriately. And again, a lot of detail on this slide, but our intent here isn't to go through it, but it gives you a good idea of where product differentiators and cost leaders spend a lot of time. One example is just to do a quick walkthrough, something like pricing decisions and how much they are influenced by product cost. Now, for product differentiators, it may be counterintuitive. You may think that, well, it's really the cost of the product that should be influencing how you price it. Again, in our first lesson, we talked about this concept of target cost. If you really think about product differentiators, what you are going to have a brand value or brand image, and if you think about different luxury items, it is not the luxury item itself that is expensive. It's really the design, sales, marketing around that luxury item that make it so expensive. So it has nothing to do with the costs, the material costs, I should say. Ultimately, it has really to do with how a specific brand wants to position its, premium brand, premium product. A cost leader, on the other hand, really doesn't have a lot of choice. It's a commodity product, not much you can do, and they are really trying to do what they are really trying to do is reduce costs so they maintain somewhat healthy margin. This again goes into the contrarian example. So there are some companies who are able to do both. And if you really think about the iPhone, most people will say, "Oh yeah, it's a premium product, premium branding, and premium pricing." Well, if you actually look at what Apple is doing, their price on, let's say, iPhone is similar to the other phones. So Apple is really wise to do that because they understand the life cycle for any product in this particular industry is very short, about 6 months. So they invest considerable amount of time rationalizing their supply chain so they can maintain a reasonably low cost and actually push away competitors as long as they can. Cost driver analysis is the last vector, and really when we think about cost driver analysis, folks try to divide it into two buckets. One is structural, so these are primarily influenced by economic structure of the industry. The name of the game is not much, what you can really do. These are all external factors that influence your cost. And then executional cost drivers, on the other hand, which are related to how companies are able to execute them. This is something that they are typically able to influence. So structural cost drivers are like scale, scope, experience, technology, and complexity. There isn't much you can do here. One quick example that comes to mind is if you are in the alternative energy space, it is almost every 3 to 6 months that there is a new invention in terms of solar panels. And you might be a market leader about 3 months ago in terms of the best in film photo you will sell. But now all of a sudden you're in a position where that technology is obsolete and there is something that's able to do twice as much or 3 times as much. So again, that's the general direction of what a structural cost analysis would try to encapsulate. Most people think about cost analysis, they always try to hone in on, hey, let's try to talk about the only things that we can control. But strategic cost management says, no, it's about the process discovery and it's about the cost driver discovery. So what you cannot control is just as much important, if not more important, than what you can control. Executional cost drivers, again, these are the things that a company can actually do to influence cost. Workplace participation, total quality management, capacity utilization, etc. But think beyond that. When you look at companies like Facebook or Google, they invest a lot of time and energy and money into cafeterias and other on-site amenities. What does it mean from plant layout perspective? Ultimately, what they realize is by investing in those types of assets, their biggest contribution and why they survive and they're able to excel is human capital. They are able to attract the best and brightest engineers around the world. So don't think just about the from conventional assembly standpoint, but think beyond that in terms of how and why you are setting up your facilities. There is also things like product configuration, so they will definitely influence your cost. Looking at both your customers and trying to help them reduce cost as well. Cost driver analysis can be broken down into two areas. The one big area, which is the focal point, is the cost of quality. So there is cost of production and cost of quality. And the cost of quality is something with strategy cost managers always focus on. This prevention costs, appraisal costs, internal failure, and also external failure. It might not seem very obvious of why and how across the quality you may have an implication, but if you're a luxury retailer and you have an external failure, so all of a sudden someone realized that, hey, these luxury items are actually being manufactured at the same shop that's somewhere that down the street vendor can manufacture in. Or think about the challenges that someone like Apple ran into when the working conditions of a Foxconn plant where workers are committing suicide, or they had carbon monoxide poisoning when they are building the iPhones or tablets. The kind of brand image that Apple had as this premium company was tarnished because of this one accident. So don't just think about it as a product quality, and that's more about the traditional definition, but think about it beyond that, in terms of what it can do to your brand value itself. And the other thing that we want to point out again is tying this back to the value chain analysis, as well as typically in commoditized industry. Most companies will not invest as much time in terms of cost driver analysis around cost of quality. In fact, they invest very less, and it's really the ones who are product differentiators will do that a lot more. So quick recap here. We talked about these three themes in strategic cost management. One thing that's very important is these are not mutually exclusive. These are not separate things. In fact, the examples we went through touch on value chain analysis and cost driver analysis. And this is a challenge you might run into during the course, where you might just jump in and say, hey, I'm going to apply one or the other. That's not the case. Feel free to apply multiple vectors, because ultimately each one of these analyses are really looking at different aspects of a business. And it may actually be useful to look at different aspects of the business. Ultimately, you may choose to go with one or the other from strategy standpoint, that is to take a cost driver analysis or value chain analysis, but there is a strong interplay here, and definitely keep that in mind. And then in the next section, we will actually go through a specific case study. But what I want to emphasize here is the differences between management accounting and strategy cost management. And here are some examples or commentary on what is the most useful way to analyze cost, for example, and the different items that our strategic cost management and management accounting looks at. So we are not going to go through this here. This is for your reference, and hope this slide will help too. And concluding remarks, we'll continue to deep dive into the differences between strategic and cost management analysis. It's important to make that distinction, and if you think about the very first lesson that we ran through, what strategic cost management is, it's really an evolution for the industry. So that's the reason why you don't see one big formula for strategic cost management. You will generally see philosophical approaches. So as you go through this lesson and others, please keep that in mind. And this is pretty much the end of the presentation today. I hope that you enjoyed the video section as well as the PowerPoint slides, and then I will talk to you in the next lesson. Thank you.